All right, everybody. Today is Tuesday, September 17th, and we are here to talk about how the options market and zero DTE trading has been driving equity markets. And we are also here to give you a sneak preview of a brand new tool we are calling Trace. Excited is not really the right word for it. I am super excited. Last time I was this excited was when we launched Hero, which is now, I think, almost 2 years ago. It's an amazing tool. We have beta users trying it out. We're going to give you a preview of that today, and we are launching that officially next week. And so what we want to do first is dig into what is actually going on in the options market, because we saw signals in early August, and I'm bantering here a minute, letting some other people come in. Amazing attendance today. Thank you everyone for joining us. But what matters here for you today, and you're all sitting here thinking like, okay, Brent, get on with it. Market just sold off a little bit here today. There is a lot of similarities between the market in early August and early September and what we are seeing today. And it's critical with the FOMC tomorrow in this 5,600 level. So we're going to show you some of the options market signals that I talk about every day with our subscribers. And then you'll be able to see with some of our new tools, including Trace. So let us get started. That's right, JT, new tool hype. I suppose I should share my screen. It's generally a good way to get presentations started. Excuse me, one day I'll learn. I've only been doing this for nearly 5 years now. All right, there we go. If you have any questions, we do have some most excellent support people on the chat, and they will be more than happy to help with that stuff. And you can also pop some questions in the Q&A. This is not really a Q&A session, but if I see some themes in there, I will make sure to get started. Luke, awesome to see you. And awesome as well to see some new names. All right, let's get going. So August 2024, one of the most famous market periods, and we're focusing on this because this was the highest or largest amount of volatility that we saw, at least as per the VIX, in many years, as you can see here, in at least 2 years. And what's so fascinating about this period, and I wanted to focus on this key point today, is that you can see this is a trend spider chart of the S&P 500 going back through July. And many of you know, especially if you've listened to me banter before, this day right here where the market started to fall apart, that was VIX expiration in July of 2024. So that was July 17th. And that really kicked off this early market weakness that we saw that led into this huge August correction. Obviously, tomorrow is VIX options expiration. VIX options expire tomorrow at 9:30. And so that is serving up a cleansing of the volatility palette, so to speak, before the Fed kicks off. Now, between that July 17th date and August 5th, the S&P lost over 8% of value. That is a very quick decline. Most people were focused just on what happened on August 5th, but the decline was very sharp and rapid. VIX really started to move before August 5th. So most people were focused on the yen carry trade and all of that on August 4th, and when things started to get really squirrely on August 5th. But if you were a Spot Gamma subscriber, we gave you very clear warnings ahead of that something was amiss. And so the critical factor here is you could see that in the options market data and in the options market flow. This is not opinion. We're going to show you the stats and the data, and you can look at that data that is lining up in a similar fashion now. So how did the options market warn us? And again, this is really aligns with what is happening today in my view. Here is our view from August 1st. What you'll see here is positive gamma erodes essentially under 5,500. And how do we make that statement? Well, in orange is call gamma, in blue is put gamma. And as a kind of naive way of stating this, anytime you have balance between calls and puts, things are generally pretty stable. Further in the S&P 500, because it's dominated by call selling, you will see that indeed there is positive gamma kind of up into this 5,700 area, and we generally state that as a well-supported low volatility zone. But if you look at this chart, and you can see this under 5,500, the blue bars are larger than the orange bars. So at a most naive look and a basic look, you can see, okay, put positions are larger than call positions when we go under 5,500. And for that reason, on August 1st, we said, look, if we break 5,500 in the S&P 500, expect a very quick test of 5,400, and that happened intraday. We lost about 2%. Now, a 2% decline in this market was actually something of an anomaly. Many of you who have followed Spot Gamma for a while know that we are flagging all of these never seen before moves into July, right? Largest number of days without a 2% move, up or down. Record low correlation, all of these other kind of related ideas. And so the critical idea here is that under 5,500, we were in negative gamma. Thursday, August 1st is when this happened. And you can see here the S&P lost about 1.6%. That bounced off of 5,400, and that led to a kind of nasty move on August 2nd, which was Friday. So again, all of the pundits, all of the people are focused on what happened on August 5th. And I know that I felt a lot better about what was happening on August 5th, being long some VIX call options or long some put options or just kind of reduced equity exposure. You sleep much better at night when you know this kind of risk is coming. And then when suddenly the market or the world is falling apart and everyone's going, oh no, what's going on? You can sit back and say, I don't necessarily care what's going on. I just own a bunch of VIX calls, and so I'm pretty happy with the volatility. So what happened then on August 2nd? The risk intensified, as you can see here. This was August 2nd, this chart right here, and that set the stage for what was really a nasty setup. And in fact, if you go into our founder's notes, this is a direct quote. And if you are a SpotGamma subscriber, you can go back and review these notes. In fact, all of our notes back to January of 2020 are logged there. And we said, quote unquote, we see no reason to hold long stocks and or be short volatility. This is a nasty setup in an environment wherein we try to protect capital. That was not a statement that was buried somewhere at the bottom of our note or anything else. That was the top headline of the note on Friday, August 2nd. And it was because of two things. This negative gamma dynamic. We're going to show you how you can view this negative gamma dynamic for yourself with the Trace tool. And the second one was the percolating or warmed up volatility position. And the key thing here, and many of you who follow SpotGamma obviously are aware of this, that when volatility is a little bit warmed up, that's also a position where we get negative gamma and kind of like simmering volatility. That is a nasty setup, and we have that right now. Obviously, we don't know with the 50-50 Fed, or we're going to get a 25 or 50 bip rate cut, who's going to be able to sort of forecast what happens out of that meeting. I don't know, and anyone else who says they do is kind of full of BS. But I can tell you that if we break 5,600 in the S&P, the odds are, in my view, that the distribution or the next move is going to be sharply lower, and we're likely to get a big VIX pop if we break that 5,600 level, right? It's an if-then statement, and that is our key risk level. Our key risk level is not 5,600 before today, but the positions have now shifted. Again, we're going to show you this momentarily. Now, critically out of this was, look, you want to protect your capital. You need to be concerned about this situation. And obviously on August 5th, it was the yen or whatever else you want to blame it on. Things really broke on August 5th. And you can see that in this chart here, where we opened down near 5120. This is the infamous, did the VIX really break 65 argument? Well, liquidity dried up, and it was just a nasty, nasty environment, as we discussed here in our note. Now, what you are looking at here is our brand new Trace tool, and what it is showing you is the actual positioning on August 5th. In fact, when we launch Trace, you're going to be able to go back and replay in real time all of the previous days that we have logged. So you have several months of data. You can go back and see how did the market react on this specific day, and you can replay that through time. And this is a real-time tool. We will also make a note of that. What you are seeing here, what Trace is reflecting is, as the S&P opened, which is this candlestick plot, around 5120, we had a very negative gamma environment. This is what we said here is like, look, under 5,500, it's negative gamma. That's what our kind of macro equity analysis was showing us. And then on the day, in real time, when we're in the trenches, you can see our Trace map here is bright red. What is the bright red telling you? It's a negative gamma position. Negative gamma, as we're going to show you, it's statistically linked with high volatility. And there's older studies that if you look at, GEX levels, that shows you volatility, and we have produced statistical significance out of our Trace maps that will also link negative gamma with volatility. So what you see here is at 5120, the market immediately following the open, the market found support, and it's moving through this negative gamma environment. Now, one of the things that is really interesting in this current environment is the proliferation of zero DTE options. We've all heard about it. You all know about it. Well, what Trace really shows you is the real-time impact of how zero DTE positions are changing the gamma landscape, how it impacts the market. So what do I mean by that? How can we say that this was bullish? Well, on your left is the trace map from around 10 in the morning. And what you can see here in red, and again, for those of you who are saying like, tell me more about trace, I need to know more. There's a full webinar next week on the 24th when we officially launch the tool. I'm trying to here lay out how at a high level we can catch these moves. What we see here is when the market opens, there's a ton of 0 DTE positions. This little box is checked, which shows you 0 DTE positions. And in blue is positive gamma strikes for dealers. And as this updates in real time throughout the day, what you see is there's a lot of positive gamma that starts to come in after the market open. So we open in this kind of negative gamma position, but very quickly as the day advances, we're getting positive gamma strikes coming in from the marketplace. Positive gamma strikes is driven by dealers getting long calls or long puts. And so what you can see here is that there's a lot of positive gamma coming in. The map is no longer so intensely red, and we rally up into the day's highs. And then what you can see is that all of these positions get closed up. There's 0 DT positions that are monetized, and the market loses all of that positive positioning and suddenly fades back down into what is left as the only positive gamma strike for 0 DT on the board, and it was a big giant one at 5150. And the market moves exactly back to this key positive gamma level of 5150. And there's no way as a market forecaster I can know how the 0 DT positions are going to react in real time, particularly in such a volatile day. So what we're able to do at SpotGame is we can say, hey, everybody, this is the environment that we are in. It's a high volatility environment. Positions are likely to shift rapidly. And then when we're looking for those 0 DTE call buyers, or we're looking for put sellers to come in on the 0 DT space and monetize short-term positions, you can watch that develop in these real-time tools. And I also want to be clear about something before I kind of advance on this. There's nothing naive about these gamma charts. They are based on our new proprietary real-time dealer positioning. So no longer is there assumptions about all calls being sold or all puts being bought. This is taken us several months, and I don't want to get too much into this right now, but this has taken us months and months of aggregating data and new modeling to back the data in these charts. Now, back to the high-level analysis that so many of you are here for. When we look at options-induced stability and positive gamma, it helps to tell you when you can get back into the pool. So we are at risk tomorrow of breaking this 5,600 level, and we'd have a negative gamma response to that, a pretty high volatility environment in that situation. And so on August 6th, which is just after obviously the big crash on the 5th, we said that we are not really in a full risk on stance again until we cover this key level, which was 53.15. And it was specifically 53.15, not 5,300, 53.15. And the reason for that is that is where we saw enough positive gamma coming into the market that dealers and market makers were likely to support the market at that point. And so the situation here was that a lot of times in a negative gamma environment, or many people say in a bear market, you can have humongous rallies, right? You can have some of the biggest rallies in existence during bear markets, and then what happens with those rallies? Well, they fade, right? They give it all back in the matter of moments. And so the critical thing here that the options market was telling us is like, look, you want to have stability to be a bull, right? Yes, it's fun catching the big 3-4% move, but then it sucks, excuse my language, as soon as that move gives it all back. And so we said, look, watch for 53.15. And to give you an idea of how these rallies faded, what you can see is that this is August 5th. On the 6th, we rally to 5,300, we reject. 53.15, reject. The next morning, we open at that 53.15 level, we reject. And then finally, on August 8th, we recapture and we close above that 53.15 level. And that is where you can see the volatility comes out of the market, right? These ranges are much tighter. And then you can see there's also this big basing and rally. And the market, at least until the beginning of September, didn't look back. We had just a tremendous move higher, and we rallied all the way back. And that supportive gamma positioning, not only are dealers buying the dips in that situation and selling the rips a little bit, they're compressing volatility a little. That also serves to allow volatility, implied volatility, to drop, right? And that we often refer to as kind of the Vanna flow. And so there's a lot of dynamics baked into this idea of, hey, 53.15 is bullish. Well, we are putting together a lot of pieces behind the scenes to help our members get a hold on these fundamentals. So I assume, or I shouldn't make these assumptions, that many of you are familiar with Spot Gamma and who I am. My name is Brent Kochuba, and I have about 20 years of institutional experience I was at Bank of America and Credit Suisse on the derivatives desks there, and then I worked at Wolverine. I was a broker there for one of the biggest options market makers. I then worked for a family office, so I was on the buy side where I did nothing but model the S&P 500, and it is there through that modeling of options positions in the S&P 500 that I came to understand that, hey, these positions really do impact the way that the options market moves. And so we launched Spot Gamma in January of 2020. We were one of a very few number of people highlighting the dynamics of options flows moving markets. Of course, when you fast forward to meme mania in 2021 and zero DT trading and everything else, there's a lot of other people trying to jump on that options analysis bus, but we are in the front of describing how these flows matter. So let's frame specifically what this type of analysis is. We've coined the term positional analysis. And what that is we are looking at how large entities are positioned, specifically options market makers and options dealers, and we are determining or estimating how they need to hedge going forward. And it is those hedging flows that we use to determine how the how the underlying market, be it the S&P 500 or a single stock, may perform. Is it a high volatility environment? Is it a low volatility environment? Where do we see support and resistance, et cetera? Now you compare that to fundamental analysis, which is obviously like, how many cars is Tesla going to sell? I think they'll sell more cars. I need to buy the stock. Or technical analysis, where you're watching moving averages or Fibonacci retracements or moon cycles. I think moon cycles are considered part of technical analysis. There's a guy who shows moon cycles. Just made me think of it because it lines up with options expiration. So it's kind of funny. Why does the options volume matter so much? It is because options volume has exploded in the last 5 years. This is a fantastic chart from the OCC and the NASDAQ, and you can see it was the proliferation of electronic trading, right? You can trade from Robinhood on your cell phone, for example, in early 2020. And then we have the zero DTEs, which is the yellows picking up, that has really just made that options volume move in a convex manner. Now, what is critical is that these options volumes link to hedging flows, and that is the trading of the underlying stock or future that is moving that underlying market. So that is the link, or we like to say the transmission mechanism between options volume and equity movement. Zero DT options, as you can see from that chart before, they are stable around 45% of S&P 500 flow. It is a similar level of volume, 45%, for the largest single stocks as well. So if you're talking NVIDIA, Apple, etc., you are seeing similar levels of zero DTE volumes. And critical to this, not shown in this presentation, we talk about a couple other places, that on August 5th, that zero DT volume, it evaporated. And that really created this interesting liquidity hole. That is something that you would see happen in real time on Trace. But because of these zero DT positions, you really need to be armed with new tools. Part of the reason that we have really added a lot of the features in the Trace tool that we have been discussing here today and will be unveiling next week. It is also highlights the importance of a flow tool like Hero, which is really showing you in real time how these positions move. So the key takeaway here is that many of you may be saying, hey Brent, I am a futures trader. I kind of understand why I should care, but not really, or I just trade spiders, not the options, why should I care? And what I'm telling you is everybody here is a form of an options trader, because where these options flows, the market goes, is what we like to say. And so this matters for stock traders, options traders, futures traders, because when these negative gamma dynamics kick in, or when you have positive gamma support, it can change or help you to understand how to augment your own trading strategy. And that is really what's critical here, again, as we watch this 5,600 level into the FOMC tomorrow. So let's cover briefly how and why these options flows transmit into the underlying stock. Some of you have seen this example before, and it is the idea here that when we were all sitting, me being a retail trader, just like many of you here, we have a lot of institutional traders as well, and the flow all works the same. When we're putting our order into Interactive Brokers or Tasty Trade or Public, and we put our order in, it goes down to one of 16 or 17 different options exchanges. Now, 90% of the time was the recent data we've seen. 90% of the time when you put an order in, you are going to send that order and it is going to be traded against an options market maker. Many of you know the names: Citadel, Susquehanna, Wolverine, Jane Street, etc. And so those are the entities providing liquidity to you. They are filling your order. They provide a very important role in this market. The options market, for as big and complicated as it is, it's a wonder of how liquidity seems to be very stable and robust. So when we put in a bunch of individual orders, by themselves, they can be fairly small. So if I say, hey, let's get on Wall Street Bets and we all want to buy August AMC calls or September AMC calls or whatever it is, we go on to Wall Street Bets and we all say, great, we're all going to buy 10 calls. Individually, there's not a lot of exposure for the market maker in that situation. But if you have thousands of people responding with buying 10 calls, you suddenly can accrue a very big position. So in this example, you have tons of individual small traders fire their orders in, and you have a market maker sitting there going, uh-oh, I just sold 100,000 calls in the last few minutes. I have some risk and I need to hedge that. Now, 5,000 calls, if you're talking about 100,000 calls at like a 50 delta, you're talking about possibly up to 5 million shares of stock. That can be a lot of stock, just as a rough example. So the starting point when you're trying to understand options market maker hedging or any options hedging is delta. And if you understand the delta, you know how many shares of stock you need to buy or sell in order to hedge a position. So in this case, if a market maker has just sold 100,000 calls, they need to start buying stock. And the critical thing on this chart, as you can understand, is that the more the stock goes up, the higher the delta is, which infers that I need to buy more and more shares of stock. And if the stock turns and starts to go down, I, as a market maker, need to start selling those shares of stock. Now, you can model delta with something like Black-Scholes or another type of options formula, but this is the basis for options hedging. So understanding delta, you can then predict how your hedging flows are going to change if the underlying moves or if time passes. And this is a very interesting and kind of critical thing to note. So again, what we have here is traders buy a bunch of options. The dealer must hedge. In this case, in our AMC example, they need to buy a bunch of shares to hedge out some short calls. And it is those short calls that get hedged where dealers go and buy the underlying stock that can move the underlying stock. So that is specifically the transmission mechanism. It's that delta hedging. Now, delta is not constant, right? Delta is constantly changing. One of the ways that we measure delta is by what's known as gamma, which is referred to as a derivative of delta. And all gamma is it tells us how much our delta changes when the stock moves. So if the stock goes up, I may need to buy some more stock. Gamma tells me that. And if the stock goes down, I may need to sell some of my stock holding. And that's what gamma is also helping me describe. So gamma tells us how much we need to trade for the underlying price shift. And what's critical here, and as we get into the negative gamma examples from these charts here, right, there is a link between gamma and how much dealers have to buy or sell and volatility. So when we have a positive gamma environment, you can see a one-day forward change in the S&P. In other words, if I know I have positive gamma today at 5 in the morning, I can predict there will be a lower volatility environment than if there's a negative gamma position, in which case you can see this orange represents much wider price distribution. And 5,600 here is that level to watch, right? Positive gamma above 5,600, negative gamma below. So that's why these hedging flows can matter, because if the dealer is adjusting their shares bought and sold for changes in price, they hit a point in which case their position is a negative gamma, which infers that they need to start selling shares of stock. The second way, and one of the other interesting ways we can describe how delta changes, is with time. And as an example here, what we see is I took a 1 month option, which is blue. And you can see that if you look down about $5, this is strike, or up about $5, you can see the delta here is about 80, and this is a call. It's about 80 delta for the 95 strike call and about 20 delta for a 105 strike call. Well, what happens as time passes? You can see that the delta for the out of the money options starts to decrease. And this makes sense because when you get to expiration, either your option is in the money, in which case it's a 100 delta option or basically trades exactly like stock, or it's a 0 delta option and it's out of the money. And so what's so fascinating about this is that your delta becomes essentially binary. It's either worth something or it's worth nothing. And the closer we get to expiration, and even in the waning minutes of the day, right, these deltas can shift around a lot. And you can imagine that the dealer exposure tied to those 0 DTE positions, which have these big deltas flipping around, can really adjust quite quickly. And that's why it's so critical to watch how these 0 DTE options in particular are adjusting over time. It's because this becomes a binary value point, right? Hey, these options are worth a lot of money or they're not. Many of you like to track these recent condor positions that are in the market, right? Where it's a $5 wide condor, and there could be 9,000 contracts at this $5 wide condor. Well, that's millions of dollars of values flipping back and forth, depending on whether that condor is in the money or out of the money, right? So I said a lot here. Many of you, I know we have a pretty advanced audience here, so you're familiar with Delta and Gamma and Charm as well. And so what we did is we built Trace to monitor these three critical flows. So we offer a Delta pressure lens, which tells you where buying and selling pressure comes into the market, red and blue. And this updates constantly throughout the day as positions are changing, as trades are coming into out of the market. We're constantly updating these positions. So there's buying and selling pressure. We have real-time negative and positive gamma environment. As you can see here, we can very quickly give you a preview of what just happened today. Positive gamma environment being support, positive gamma environment being high volatility, blue being lower volatility. That's statistically backed. And then lastly is Charm, which really helps us to describe the decay and the impact of zero DTE positions as they unfold throughout the day, right? Because what happens is, for example, at 3:30, all of a sudden, all these people start closing positions. Well, how can you track all of these different strikes? You can do it with a mapping tool like we've built here. So let's discuss now some of the options impact and watch how the Greeks can drive price. The example here, starting with that iron condor, I believe it was yesterday, we saw this position come back in. And what is so fascinating here is you can see that condor. This chart is at 10 o'clock in the morning on August 26th. You can see there's that condor, right? The dealers have a positive gamma position up here around 5,600, and then down here below, you can see that spread, right? It's a $5 wide spread, so they have a negative gamma part of the leg and a positive gamma part of the leg. You can also show this in the open interest space if you don't want to look at it in gamma terms. And then you can see via this Charm map exactly where these positions matter into the end of the day. And so if you know this position is sitting there in the market and you can monitor it continuously throughout the day, you can see how the dealer pressure is changing over the course of the day. And as a trader, you can say, great, I know that there is this really critical position in the market. It's a dominant position in the market. And so if we visit that area, I can respond appropriately because it's not some random piece of news or some, tweet that somebody sent out hypothesizing about their emotions in the market. It is this big position that is all that is driving market flows. And so again, you see these positions change in real time. And again, the reason that you don't see this condor strike here is because at roughly 4 o'clock in the day, there's no gamma left for strikes that are 100 points out of the money, right? That gamma essentially has gone to zero for those options. Here was the most infamous day recently, was September 11th. Many of you are familiar with the comments made, and we've been talking about the NVIDIA industrial complex, for example. But on September 11th, what you saw in the S&P was this incredible response. In this case, what we're looking at is our delta pressure map. In delta pressure, when you see blue, bright blue, that is a signal that dealers have to buy a lot of shares or futures at that level. So what you can see in this case is we lay out very quickly where the dealers are positioned. These blue bars are puts in this case from the OI positioning. And you will see in this animated image, there is no blue on this map. And all of a sudden it goes, bam, blue. It hits you in the face, right? With how dark that is. That tells you that, hey, they're going to have to do some buying at this critical level with 5,400. You can line that up with this big open interest, which is often a support and resistance level. And incidentally, not shown here, there's a great hero signal embedded in this as well. And so what you see is all of a sudden, because of positions being closed and rolled in real time, you see there's just this buying response, and then we move back up into this zone of red, the red suggesting that dealers have to do some selling as we get up into those zones. So we covered a lot today in a short amount of time. This was I like to call it the amuse-bouche of Trace. I am working, and I was told not to say this, but I'm working hard to get our members, all of our members, a sneak preview on Monday of this tool in advance of the launch. Hopefully we can get that to happen. I'm sure someone's throwing their shoe at the screen right now from the Spot Gamma team because of that, but this is how I'd like to push things along. So we're hoping to give you a sneak. We'll see. Don't get mad at me if we don't. That's what I'm trying to do behind the scenes here. The official launch of Trace will be coming up here on Tuesday, the 24th. And so while we covered today significant influence of zero DTEs and positional analysis and how market makers must hedge, we basically described to you why you need to pay attention to these options flows at a critical juncture right here, right now, ahead of FOMC with VIX expiration tomorrow morning. You really want to join us for this launch event on 9/24. 9/24 comes at a time right before we're going to see the rolling of quarterly positions. You'll be able to watch the JP Morgan collar roll in real time through Hero and through this amazing trace tool. It maps out again in a continuous form throughout the entire day our proprietary dealer positioning. So you get a fantastic view into exactly what is happening in real time. And again, there's absolutely nothing naive about this. It is the latest and greatest positioning that you can possibly get. So we're really excited to be leading the market in this way. So join us, go to spotgamma.com/trace the market. You want to go there now because we are constantly trying to maybe leak some sneak previews, like I said, and some different things out. You may get some advanced notes, no promises here, but if you just go to the site now, spotgamma.com/trace the market, and get some of these critical kind of emails and notifications that we're sending out before big event on 9/24. Can we make this affordable? We do not want to price anybody out of the market. We want to take care of not only Spot Gamma members, but obviously anyone who is new that wants to come along as well. And so we will leave pricing for a 9/24 discussion, but we have a lot of interesting giveaways and things like that. I'm not sure if this is going to be recorded. I'm not sure if that has been answered. I want to show you what Trace is doing right now. This will be part of the Alpha subscription at Spot Gamma. If you have Alpha, you will automatically get Trace. We are doing what we can to be fair and open to all Spot Gamma members. So I believe this is the plan, as I understand it, that regardless of what Spot Gamma membership you are, you're going to get a free look at the tool because we want everyone to assess this. Because it is so advanced and is so new, many of you have in the past said, I don't need the Alpha membership. I don't believe in some of this other stuff. I don't necessarily think you're right on that. But because this is so brand new and so incredible, we want everyone to reassess the offering we have here. So let's look at Trace quickly now, shall we? I'm over time, but I'll be quick. All right, this is Trace actually for today. And what is so interesting about it, and we are looking at the gamma map, and that's all I want to show at the moment here. And if I zoom in just a little bit, what you're going to see is we have this negative gamma environment, and you can see right here, positive gamma kind of above this level, 5660, and we broke down through this negative gamma positioning below, and we bounced right here around 5620. Now, what's interesting and most insightful about this for today is that Hero broke really sharply, as you can see here. This purple line is Hero. So you know the intraday delta pressure on the market was bam, down we go. And that really helped to lead this market lower ahead of the Fed. And if we kind of zoom out, there's not a lot of big gamma positions. You can see this is a rough positive gamma area in here. You can see there's some short-term negative gamma positions in the market. Those by the end of the day should be disappearing or decaying. That's what we could see by the change in map color towards the end of the day. You could see a nice positive gamma response with Hero lifting off of that 5600 level. And so again, this is an example of some of the amazing insights you're going to get in real time, and you could wind this chart on back and see specifically what took place throughout the day and see how that map changes color. So there's a bunch of other lenses, a ton of other features. We have a bunch of amazing things that you can add. I'll just give you a sneak preview of another one of those. We got some amazing real-time gamma monitoring tools. And so that is enough. I'm going to get in trouble for having shown everyone that much. But again, please go right now, spotgamma.com/trace the market, or just go to tracethemarket.com. Sign up now to get the registration emails and events. There will be replays, obviously, but if you watch in real time, you'll catch some incredible insights, and as well as some of those giveaways and some of the other things we're doing. So we are definitely going with the mad 80s vibe, Corey Sheehan. I'm a child of the 80s. We're the greatest generation, I think. Hopefully didn't agitate anybody there. But we have an incredible graphics team here. They really put together some pretty fun things for the launch. So that is it. I want to thank everybody so much for joining us today. Again, if you are a Spot Gamma subscriber, we're watching that 5600 level very closely tomorrow. I'm trying to work out a sneak preview of Trace for early next week. But more importantly, we got to deal with the Fed and VIX expiration. And so everyone, even if you're not a Spot Gamma subscriber, watch that 5,600 level as a critical risk position. And if we break 5,600 and y'all make a bunch of money, then you can pay for your hot new Spot Gamma subscriptions, right? All right, that's it for me. Any questions, info@spotgamma.com. You can reach me at SpotGamma on Twitter as well. Thank you all very much for joining here today. And we hope you are now better prepared to face these markets over the coming days and weeks.